Welcome to the Property Buyble. This show was created for current property owners, people looking to purchase property, and for professionals in the industry. Hope you enjoy. Welcome back to the Property Buyble. My name is Kim Ackerman. I'm a buyer's agent from Trelease Associates here in Sydney. Today we're going to be talking about a topic that I have been wanting to talk about for at least 6 months now. It's about how to buy property without any savings, without any deposit, without any cash. I'm sure if everybody could buy property without having any savings in the bank, they absolutely would. So today is going to be the start of a multiple part series in which we'll give you different tips and tricks on how to buy property without having any cash in the bank. Now, our first series today is going to kick off talking about using a guarantor for this kind of mechanism. And today I have with me to chat about this topic, Mr. Joseph Daoud.
Thanks for having me, Kim.
You're very welcome. Joseph is a lending specialist. He's also the founder of It's Simple Finance in North Strathfield.
That's correct.
So I'm very excited to have you on. You and I have very in-depth, complicated, interesting conversations about mortgage structures and finance structures, and I think you're the best person to talk about this start of this topic with me for sure.
Well, thank you for the compliment there. I might not be the best, but I'm going to give it my best shot this morning.
Beautiful.
I always, love coming on these shows. I love being able to teach people and educate people on, different kinds of loan structures and different types of ways that they can borrow. And one of the hot topics that we do find is being able to purchase a property without the use of genuine savings or without basically having to put away money for 5 to 10 years just to be able to enter the property market.
Yeah, especially in a market like this, it's just so hot.
Yeah.
I don't know how people, especially singles as well, how they can possibly save up hundreds of thousands of dollars plus the stamp duty cost.
It's extremely difficult, especially in a city like Sydney, which is one of the most sought after property destinations in the world now. As you've seen, we went through COVID without going through multiple lockdowns like Melbourne, similar to Brisbane, similar to WA. And we're basically the envy of the world. So we've seen property prices absolutely skyrocket. Usually property in areas like Concord or areas like Burwood with a $2 million auction reserve are now going $1 million over reserve. So it is quite difficult now to be able to purchase your first property in a place like Sydney. We're doing things like renting.
Yeah.
We're also studying, and then we're trying to work full time and just make ends meet.
For sure.
It's hard to save that 20% deposit.
It's really hard. And that's why I wanted to talk about this topic. There's so much, we started talking about this topic and realized that this will probably go over 3-4 episodes, maybe.
Definitely.
Because I want to go into depth about the different ways so that people really understand this could be an option for you, or option 2 could be an option for you, or option 3, etc. So this first option we're talking about, using a guarantor to provide that margin that people would normally provide with cash. Now we're talking about the cash for a deposit, we're talking about the cash for stamp duty and any other things, legal fees. There's a whole bunch of stuff that people generally need when they go through this process. So using a guarantor, give us an explanation of what is a guarantor to start off with.
So first of all, using a guarantor does not mean free access to money. Using a guarantor means using someone else's property or possibly cash, as in a term deposit, something along the lines of that, to be able to secure a 20% deposit to be able to purchase your property. Now, I'm quite a visual person, so I like to, draw in boxes and everything like that. So everyone at home, if you're listening to this via Spotify or, via Apple Music or something along the lines of that, go on the YouTube, because I might be doing this and I might be doing that multiple times across the camera.
Yeah, absolutely.
Okay, so the use of a guarantor is it can be complex or it can be simple. Okay, so I'm going to break down the most simple method and then we can go into the more complex methods. The first method that I do want to discuss is basically just using a standalone house and using your parents' home as the guarantee. Yeah. So what occurs in this situation is, let's say you can't save that deposit, but you do want to be able to purchase a property. What a bank does is they can go to your parents' property and basically put a 20% mortgage on that property, so then you can purchase your property without paying something called lender's mortgage insurance. Now, often in these times, you can borrow up to 105% depending on how much equity is in your parents' property.
Of course.
So, for example, if your parents' property is worth $1 million and they've got a $600,000 mortgage owing, there's about $200,000 in there that we can play with.
Usable equity.
Usable equity to be able to purchase your first property. Now, let's say your first property is going to cost $600,000. You need $120,000 for your deposit, and then you need the remainder for the stamp duty.
Yeah.
Bar, of course, if we're using, first homeowners grants or anything along the lines of that.
Yes.
But let's say you're using this as an investment property and you do have to pay the stamp duty. This is going to be about $21,000 to $24,000.
Yep.
Okay, give or take. You can then use that 20%, the $120,000 on your parents' property, plus another 5%, give or take, so the extra $20,000.
To help cover the stamp.
Yeah, to help cover the stamp duty and everything along the lines of that.
And then people don't have to save anything.
Correct.
In retrospect.
Correct. Now, the risks that are involved in this, of course, is it depends on which bank you go to. So
a lot of banks don't actually allow for a guarantor structure to be used. Is that correct?
They don't like to come in as second mortgage.
They prefer not to.
Yeah.
And when you say second mortgage, we talked about this the other day. So when you think about it, for anybody that's listening, if I'm wanting to buy a property and I'm with CBA and my parents I'm using as guarantors and they're with Westpac, those two banks have to work together. Yeah. And they don't necessarily like to do that because they're sharing a property. They're sharing the security of that property. One bank has a certain percentage and the other bank has another one.
Yeah.
So would you say it's safe to say that most banks do this sort of structure, just some prefer not to?
So most banks will provide a guarantor structure, but they prefer both properties to be held by themselves.
Right.
The reason for this is priority. So property A, your parents' property, if that does go up for sale, property B, where the guarantor loan is being held onto, or lender B, where the guarantor is being held onto, doesn't have the priority and doesn't have much say in what happens with the sale of that property. So basically they have to sit and wait to see what property A or loan A does and be able to see where their money is going to be accessed from afterwards.
Right.
This is quite complicated.
Yeah.
And that's why if a lot of banks now don't provide guarantor loans unless they are both the lender on the first loan and the second loan. Yeah.
Right. Okay. And I guess if we get into some pros and cons for this kind of structure or setup, the obvious pro is that people don't need to save a deposit.
Yeah.
That takes a lot of time. By the time you've saved up several hundreds of thousands of dollars, in some case, the market has moved and properties are usually worth more than what they were worth, a few years ago. So a big pro is obviously people not having to provide that money up front. What's another advantage of using this kind of structure?
Another big advantage is avoiding lender's mortgage insurance.
True.
So lender's mortgage insurance, after you go past that 87.5% mark, it starts to get really, really expensive. Yeah. It can jump from, $5,000 to $8,000 to $20,000 very, very quickly. Yeah. And this money doesn't so much protect you, it protects the lender.
Yeah.
So this could be an extra $20,000, $24,000 that gets added to the life of your loan.
Which we have to pay for as
Which
buyers.
we have to pay for.
Yeah, but protects the bank.
Exactly.
Yeah.
So by avoiding having to pay that insurance, that's a massive advantage. You're not forced to pay all this extra money and forced to, pay a higher interest rate by having such a high LVR. Yeah. And instead, you can reap the benefits and keep that money in your own bank account.
For sure. Absolutely. And I guess some bad elements about using a guarantor. Yeah. Obviously, if you're using a guarantor such as your parents or a family member, for example, both yourself and them have to understand the risks involved with that. And obviously, all parties need to be comfortable with that kind of structure moving forward. So would you say that's probably one of the biggest cons with using a guarantor?
There's multiple risks that are involved with using a guarantor.
Yeah.
The first one that I do want to discuss is basically which bank you approach or which lender you do approach. Yeah. Because if you're going to a bank that doesn't like using guarantor loans or forces you to refinance to their their bank to be able to use a guarantor, that bank might not be suitable to you. And so there could be something along the lines of a hold up in purchasing the property. There could be delay in settlement fees. There could be just a number of things involved by not speaking to a lending specialist and going directly to the bank. The second thing is if the guarantor loan isn't structured correctly, this could put both properties in a lot of jeopardy.
Yeah.
So we've seen examples where banks have basically gone and borrowed up to 105%.
On the new property that's being purchased?
No. So they will put 25% on the old property.
Right.
And then 80% on the new property. So they've done 105%. But the guarantors think that their property is only being geared up to 20%.
Wow. Do they then get charged LMI on the guarantor property?
No. There's no LMI involved. But what ends up happening with that 105% is if there's a sale or if they want to refinance or something along the lines of that later on, they will say, oh my God, I've got this much more owing than I previously thought.
Yeah.
So it's just, there's a lot of risks that are involved in going with a guarantor loan. You just need to speak to the right person to be able to do so, to make sure it's structured correctly.
Right. And that's the other thing. I think a lot of people don't fully grasp the concept of when you're looking at a guarantor loan, as soon as one property is security on another property, those two properties are now linked in place. Now, what that actually means is if one of those people decided they wanted to sell the properties, for example, if my parents are guarantor for my property, my next property that I'm buying, and now they are linked and I owe more than 80% on my current property and my parents are at 80%, however, they're still linked to me, you have to unlink them for my parents to be able to sell because they are security on my current property.
Correct.
It can get very complicated in that sense.
Yep.
So I think a lot of people that I speak to, especially buyers or first home buyers, they don't realize that if you do use a guarantor structure, you can wait for that property to go up to that 80% LVR or down to the 80% LVR mark.
Yep.
So what that means is if they're borrowing or getting security from parents of 20% on the other property of their family home, for example, if their new property that they purchase goes up so much in value that it's now at 80% LVR versus actual value of the home, they can release their parents as guarantor. Is that right?
That is correct.
Yeah.
So guarantor structures aren't supposed to be quick fixes.
Yeah.
They're not supposed to be, we'll do it for 6 months, we'll do it for 12 months, and then we'll release mum and dad.
Yeah.
Guarantor loans are usually for 3 to 5 years.
Yeah.
And you have to speak to your parents or, whoever your guarantor is and let them know of the risk of that, that their property is going to be linked with your property. We see the biggest risk when the sale of the parents' home or they want to downsize and they're expecting the proceeds from their funds to be able to purchase a new property. Now, let's say, for example, we've got property B, which, we've borrowed up to 90% on it.
Yeah.
Okay. So there's still that 10% little amount remaining and we sell mum and dad's property. Okay. The proceeds of that sale, whatever's remaining on the guarantor portion, won't go to the parents. It will actually be held in a term deposit so that guarantee stays.
Yeah.
And that's where the conflict arises between the two banks. And that's why the two banks don't like working with each other.
Yeah.
That's why a lot of banks would like to if they're going to guarantee, they want to hold both properties so they have control over both properties. That way that they're not going to be clashing with another bank down the line.
Makes sense.
Yeah.
And I think it'd be good for us to just explain to people, if security is placed on your parents' property, for example, you still have the 100% loan that you need to pay off.
That is correct.
So it's not like your parents get another little smaller loan that they need to pay on the side. The whole amount gets put over to you, the 100 or the 105%, whatever amount you're using as security in total. And that new purchaser that's purchased the home pays for the entire loan. The margin that is normally paid up front with cash, though, is just used as security on their property. So if anything happens to you, if the market drops and you decide to sell and you have this shortfall in place, there is that other property that the bank can go after if need be.
Yep, that is correct. So the main thing that we need to look out for is if you can service this loan.
Yeah.
So this is where we do have to find the best situation for a guarantor loan to exist. The best situation for a guarantor loan to exist is if you are earning a higher income and you can service that $600, that $700, that $800,000 mark on your own or with your partner. You don't want to be leaving your parents in a risky situation, or, you know, your guarantor could be your brother, could be, you know, sister. We've even seen situations where it could be your uncle. We want to make sure that we're not putting them in jeopardy by going for a guarantor loan.
All right.
They are just mainly assisting us to cover that 20%.
Right. And that's the other thing. These people have to service.
Yeah.
Like, it's all well and good to say, I want to buy that $1 million property and I don't have any money, so my parents are going to be a guarantor, and then I'll just get a loan and I'll get that property and everything will be fine. You actually have to be able to service 100% of the loan if you're going to be borrowing 100% of the purchase price, or 105 in some cases.
Yeah.
So that's sort of the second part to this. But I must admit, saving the cash for a deposit and stamp duty is probably one of the hardest parts that I see people go through.
Definitely.
If I didn't have to go through it, I would have a much larger portfolio than I have now, because I'd constantly want to be buying and trying to service on the side as well. So that's also a really big part.
Yeah.
But I think if we just touch on one more thing that we have spoken about, and that is being a guarantor for yourself.
Yeah.
Self-guarantee, I think it's called.
So self-guarantee can be broken up into two different ways. Let's talk about cross-collateralization first.
Yeah.
So cross-collateralization is basically using one of your properties and tapping into the equity of that property to be able to purchase another property. These properties are all rolled into one loan, and then that way you can leverage up to 100% or 105% onto one of the properties.
Okay.
So let's say, for example, I've got my owner occupied property. I've built up equity in that property. I've paid it off over the last 5 years, and I've got some money that I could tap into there. I see an investment property that is possibly positively geared, negatively geared. Don't want to get into that too much right now.
Yeah.
I've got another property that I, you know, see a lot of value in, and I service for that loan. I can actually combine both assets into one loan. This is cross-collateralized, and go and purchase that property.
Yeah.
With the equity that's in my first property.
Okay.
Yeah.
But self-guaranteeing, isn't that something just slightly different from the whole cross-collateralization?
So there is another situation where you can self-guarantee,
Yeah.
where you're basically got your initial home loan and then you're putting another guarantee on that loan. However, it's very, very rare that we do see these situations these days.
Yeah.
There are extremely limited amounts of banks that will allow this, mainly because of best interest duty.
Right.
It's not in the best
we
interest
talk
of
about
a
that
client.
a lot.
Yeah.
Best interest duty.
It is not in the best interest of the client to be able to do that.
Right. Okay. What kind of ways would someone be able to self-guarantee? Because in my mind, if I was someone listening to this and knew nothing about how to structure loans and so forth, you think, well, if you can self-guarantee for yourself, wouldn't you have the money to put down a deposit?
Yeah.
So what are some of the other ways, creative ways, you could self-guarantee without necessarily cross-collateralizing on another property or providing the cash?
Okay.
Is that a loaded question?
It's a very loaded question. I don't want to get into that. Like, that is like...
There are other ways though.
There are definitely
with
other ways.
With company structures and so forth that you can self-guarantee.
Yeah.
Obviously, everyone should check with their financial planner, their accountant before they go and do anything crazy like this. But there are other options to
So this is definitely a situation where you'd want to bring in a financial planner that is working closely with your lending specialist or mortgage broker to understand the best structure that you can self-guarantee. I have seen very rare occurrences and unique occurrences where people have self-guaranteed using their commercial properties, using their income, their company income. But yet again,
complicated.
Extremely.
Okay. Yeah, we definitely want to get into that.
This isn't a situation. So in those types of situations, what you would often see is the people actually do have the money for the deposit.
Yeah.
But they want to stay liquid.
Yeah.
And they want to keep that cash as a reserve.
Yeah. So it's moving money around and putting it in the right
So if we're talking specifically to first home buyers right now, they wouldn't be using that kind of situation.
No, absolutely not.
Yeah.
And there's so many different branches off of this topic, which we could absolutely spend hours talking about. But I think if we get into some of the ways or tips to summarize some of these things and tips for people to take home or take away from this episode to think about possibly using. Once again, I'll just preface, like, everyone's situation is so different.
Yeah.
So what works for someone with a guarantor may not work for someone else. Someone may not have a guarantor to be able to use, so they might find useful some of the other episodes that we have coming up on these different topics as well. But I think if we go into some of the tips, first and foremost, speak with a broker if you can.
Yeah. So my first tip is speak to a lending specialist and make sure they're an experienced lending specialist. The reason why I say this is because you don't want to have a guarantor structure that is going to put you in jeopardy in 3 to 5 years.
Yeah.
We've seen this happen before.
Yeah.
We've seen it happen where basically somebody thought that they had only one property that they were using as a guarantor in a guarantee.
Yep.
They weren't aware that that property was cross-securitized with other properties.
Yeah, wow.
And then when they went to go sell one of the investment properties, there was a massive encumbrance and issues and just, delays in settlement and everything like that.
Yeah, wow.
So it's always good to speak to a lending specialist first, okay?
Well, you guys can juggle all of this.
Yeah.
So I always say to people, it's kind of like when you use a buyer's agent. I'm not going to go to one real estate agent to find only their properties.
Yeah.
I'm going to go to every real estate agent to look at all of the options. And you guys are working with, 20, 30 banks sometimes. And you'll be able to say
35 plus.
35 plus, sorry. For you guys, 35 plus. But you'll be able to say, these are the best banks for us to look at because they're able to work around our structure and the best way for us or the best way for the client anyway. Also, I guess please understand the risks and implications associated with using a guarantor and make sure that your parents or whoever you're using also understand those risks so that everyone's on the same page when you're going down this sort of structure.
Yeah, definitely.
I think another thing that I wanted to make sure I mention in this episode that I know I've spoken to you about before, I've been through this situation using a guarantor many, many years ago, 10 years ago when I was purchasing my first property. And one of the things I did a lot of research on was, obviously you've got your LMI, your lender's mortgage insurance. There was another specific type of insurance that I was able to research because I was very worried, what happens if, knock on wood, if I get hit by a bus tomorrow, if something happens, if I get very sick, I don't want my parents to be responsible for having to pay off my property. I don't want them to lose their home. All of these sorts of things went through my head. So I researched this specific type of insurance that was very minimal. I think it was something from $30 a month at the time that allowed me to be covered. It was sort of like a loan insurance that was in place and an income insurance. And that covered us completely so that if anything was to happen, I didn't have to worry. So I think that's another option, sort of like an out of the box option that people could think about.
Well, it definitely is because look at that. That was $30 a month, which is $360 a year. Okay. I've seen people spend more on dinner.
Yeah.
Okay. Like, let's be real. $360 a year to make sure that your parents are safe in that and you're safe is minimal.
Yeah.
Compared to the advantage that you can gain from entering the property market early. So we're speaking 10 years ago that you purchased this initial property and there's a good chance that you didn't use a deposit or something along the lines of that. That small $360 that you're paying, can grow exponentially just because of the way that Sydney's property market behaves or Melbourne's property market behaves. Another risk that I do want to speak about is which properties are being used for guarantor loans. Now, Sydney, Melbourne, Brisbane, they're generally safe. But we see areas like Perth, that can definitely fluctuate. Especially because of mining booms, mining troughs and everything like that. We've seen properties go from $2 million to $500,000 in a matter of years just because the demand isn't there anymore. So when you're guaranteeing a loan, you want to make sure that you're guaranteeing the right property as well before you're going ahead and purchasing too.
For sure. I mean, the intention is for both of those properties to go up in value, but that doesn't always happen. So having good quality, blue chip properties or what have you in capital cities or in areas that have infrastructure growth happening are going to help that process and are going to be able to allow you to remove your guarantor sooner than anticipated as well. I think I waited, less than a year before I could remove my parents as guarantors for my property and be able to have only 80% LVR remaining on that property, which is great. And the capital growth helped me do that as well for the area that I bought in. But look, that's really a wrap up for this episode. We could talk a lot more on this, but I think they're the big touch points that we wanted to talk on.
Yeah.
To just give those explanations of, what is a guarantor? How does it work? It's always good to speak to your broker or a lender that you're working with, a lending specialist. Make sure that you speak to your financial planner, your accountant during this process so that you understand what you're getting yourself into.
Yep.
But it is an option for people who don't have the time or don't have the capacity to be able to save a deposit and or stamp duty during this process. So good luck to everybody out there that's trying to buy property. Thank you, Joey, for coming in.
Thanks for having me.
Loved having you. We've got more episodes coming up on the different ways that we can buy property without a deposit and without cash. So stay tuned. Thanks for listening to this episode and good luck.